Hello, everyone. Hope you're all having a great weekend. So, apologize for the delay on getting this out. I had some family in town and was spending some time with them over the weekend here. So, just now getting to this on Sunday morning. So, things continue to be moving along well from a standpoint of performance, but we do have a couple of clinkers hanging out there, as you know. So again, overall, great returns of things that have closed. We had a couple small losers that expired or closed this last week. That said, again, overall, looking pretty good. But we have one that's going to be hitting that graph here most likely at the close of business tomorrow, and that's going to be this calendar right here. So, if we get some sort of a miracle pullback tomorrow morning, we might be able to benefit from that. But, I think it's unlikely at this point. So this thing will be expiring and it will be in this $1,100, $1,200 loss range on this particular trade. So that's certainly going to give us a little pullback in that equity curve, but that's to be expected with trading. So this one will be off the plate here tomorrow. Then this one, again, assuming we open in the general expected range, the futures aren't open yet, so I don't have any indication really of where things are going, but I would expect a normal range here, maybe 30 points either side of the 4,300 mark. So this one should decay further, and we should be able to pop off one or two more of these, possibly tomorrow and Tuesday. And then, of course, we got some Fed speak that's going to be happening on Tuesday and Wednesday. Ultimately, I'd like to get this thing really thinned out before any significant Fed announcement coming up. This one, we may look at raising this right wing on this. Again, kind of want to see what happens with Fed talk, because if it's something that, powers the market significantly higher, moving this wing isn't really going to help much. We won't be able to get enough out of it to move it. If it powers it down, we may not need to move it. So we'll take a closer look at that after we get some Fed news on that one. This one we'll take a look at. It's possible that we may just do some some diagonalization on this one, maybe diagonalizing a couple of these kind of as a preventative measure. But again, kind of want to see where things are at come, mid-late day tomorrow. Same thing here. This one, I don't think we really need to worry too much about right at this point. It's quite a ways out expiration-wise, as is our rut. So neither one of these are what I would call pressing in nature. So those are the positions we have open. We do need to, and I've said this a number of times at this point, we do need to kind of reset our expectations in this lower VIX environment. Now, our trading so far this year, VIX has been anywhere from 25 to, 20 down to 18, 19. VIX is at 13 and change. That is just ridiculously low, particularly when you stop to consider some of the stuff that's still sort of hanging out there, from a standpoint of just the political world, some companies' earnings not holding up as well. There's a number of cross currents here that kind of surprise me that VIX isn't a little higher than what it is. And again, the kiss of death in income style trading is to be sized up too much when you get that shift from low volatility to high volatility. Right now, I normally try to give people kind of a gauge of where I'm at in my overall account use. I only have about 25% of my account deployed at this time. And it's for exactly that reason. When we get that shift from low volatility to high volatility, these positions, butterfly type positions, condor positions, are largely going to take a significant hit. And so you want to be downsized during that period of time. Of course, that does mean you're going to get less opportunistic trades that you can make. The trades aren't going to be as juicy. They're not going to have as good reward to risk ratio in them during this lower volatility, but it's a way to stay safer in the trading where we kind of scale back and downsize. So looking at our market, again, we know that the SPX has been making higher lows. It's been pretty consistent at that. It's also been making some higher highs. Now, we are at a fairly significant, what I would call, pivot point here at this 4,300. This had been, support here, support here, support here, broke down, became a little bit of resistance, but popped through it, again, came back, chopped around that 4,300. So there's a number of places where we kind of have some battle lines, is kind of how I look at them, being drawn, or that have historically been drawn around that 4,300 mark. And of course, we're right back there at that battle line right now. So what I would anticipate is whatever happens here is going to be largely Fed announcement driven this week. So right now, the latest number I saw baked in only about a 25% chance of another rate hike, about a 75% chance of no rate hike. So if there is in fact a rate hike, I would anticipate that we might get a significant move down from this 4,300. If in fact there is no rate hike, I would anticipate possibly a move up. But again, I think it's largely baked in that we're not going to get one. So I don't know if that move up is going to be sustained. I'm thinking, probably an initial pop, maybe to the highs that we hit on Friday, this 43.20, and then maybe a fallback, but not as severe of a fallback as if we do, in fact, get another increase announcement. So regardless, I'm envisioning that we're going to be playing in the maybe as low as 4150 range up to probably this maybe almost a 4400 range here over the next month or two. But again, I'm leaning a little more toward 4300 and south as opposed to 43 to 44. But it's really hard to tell until we know more about the news coming up this week. Anyhow, that's kind of my take on things. We have to be a little careful on new trades that we're going to enter as well. We have been trading butterflies, 60-50 butterflies. It's entirely possible that we may need to start going to 60-40 butterflies. Those will carry more positive delta with them. They will get hurt a little more in that big volatility shift if we go from low volatility to high volatility. So we're going to keep our size smaller, but that is one way to combat this lower volatility environment, is that the put spread that we sell will be 10 points wider than our normal 50-60. So we're going to buy a 40-point wide put spread and sell a 60-point wide put spread, as opposed to buying a 50 and selling a 60. So that's one way to keep that right wing raised up a little bit higher. So if volatility does not, in fact, pick up this week and we go to put on a new trade, it's entirely possible it may be configured that way. So that's it for the wrap up for this week. Thank you, everyone, and we will see you in the circle here throughout this coming week. Take care.